All right, let's unpack this. Today, we're diving deep into an automated investment system that's been making some waves. AIFEEX's AI-DeFi staking. It's a platform that, well, according to our sources, promises daily returns and aims to simplify the often pretty complex world of decentralized finance for you, the investor. Our mission with this deep dive isn't just to describe what AIFEEX offers, but, to truly get under the hood. We'll explore its core mechanics, critically examine the impressive daily returns it claims, and analyze the strategic implications and potential advantages this system presents, especially for those navigating the DeFi landscape. We'll also address some of the bigger questions an informed investor like yourself should be asking.
And it's an interesting set of sources we've reviewed for this deep dive. They are noticeably accessible, clearly designed, it seems, to introduce the AI-FEEX system to a broad audience. That includes people relatively new to AI-managed investments, or maybe the DeFi space itself. This approach, while helpful for that initial understanding, means we'll need to dig a bit deeper, to uncover the nuances and specific operational details that an informed investor would expect.
Exactly. So let's jump right into the heart of the system. What's central to AIFE and what makes it distinct is its powerful AI. The sources describe it as the engine managing your investments automatically. This isn't just about passive income, it's really about a hands-off approach to crypto staking. Now, for those perhaps newer to the concept of staking, at its most fundamental level, it typically involves locking up your cryptocurrency to support a blockchain network's operations, earning rewards in return. But AIFEX takes a unique spin on this. Here's how it works, according to the sources. When you decide to stake USDT, and that's a crucial detail because USDT is a stablecoin pegged to the US dollar known for its stability compared to more volatile cryptocurrencies, you channel it into the AIFEX system. The moment your USDT enters, the AI immediately kicks off this, fascinating asset split. Your investment is instantly divided into two equal halves. 50% of your USDT gets converted into AFX, which is AIFEX's own platform coin, the other 50%. That's converted into USDI, another stablecoin that AIFEX has created. It's an instant automated diversification right at the point of entry.
This 50-50 split between AFX and USDI, it does feel like a strategic move, and it's definitely worth a closer look for any investor thinking about this. On one side, you've got AFX, the native utility token of the AIFEX ecosystem. Its value, theoretically, is tied to the growth and success of the platform itself. So holding AFX gives your investment that potential for upside if the platform gains traction and its token appreciates in value. Then on the other side, you have USDI, presented as stablecoin. This part of your investment is meant to offer stability, anchoring some of your capital against the notorious volatility of the broader crypto market. The underlying logic appears to be this dual approach, trying to capture potential growth from the platform's native asset while mitigating some risk with a stable asset.
Right. And this brings us to a critical point for our informed listeners. When we talk about USDI as another stablecoin by AIFEX, the immediate question for anyone familiar with DeFi is, how does it maintain its peg? What's actually backing it? The sources indicate USDI is an AIFEX-issued stablecoin designed to maintain stability. But they don't really go into extensive detail about its specific collateralization model, whether it's backed by fiat reserves or maybe over-collateralized by other cryptos, or if it operates on some kind of algorithmic mechanism. For an informed investor, understanding the robustness and, frankly, the transparency of a proprietary stablecoin's backing is absolutely paramount to assessing its true stability and risk profile. It's a key area where, more detail would certainly strengthen investor confidence.
Indeed. The nature of USDI's backing directly impacts how reliable it is. Without clear, auditable information on its collateral or its stability mechanisms, it introduces a layer of platform-specific risk that's quite distinct from using a widely adopted, transparently backed stablecoin like the initial USDT you put in. It's a subtle but pretty significant distinction when you're considering the safety of your capital, particularly that 50% allocated to USDI. This balancing act, as you mentioned, creates a unique risk profile. Half your investment is tied to a potentially growth-oriented but inherently volatile platform token, and the other half is tied to a proprietary stablecoin whose underlying mechanics honestly require more scrutiny for a truly deep understanding.
And the sources really emphasize that once you've staked your funds, the AI truly takes over. This is positioned as a major selling point. You don't need to manually trade, constantly monitor market fluctuations, or make those day-to-day decisions. It's presented as a sort of set it and forget it experience, which aims to be incredibly appealing for people who value their time or maybe don't have the specialized expertise to navigate the complex and fast-moving crypto markets on their own. The convenience factor is clearly a high priority here.
That perceived convenience is a powerful draw, no doubt. However, for an informed investor, That description of a powerful AI immediately prompts a deeper question. What exactly does this AI do? Is it leveraging machine learning models for predictive analytics? Is it optimizing staking pool selections across various decentralized exchanges? Is it dynamically rebalancing asset allocations based on real-time market volatility? Or is it operating on a more, let's say, rule-based automated system? Understanding the operational scope and the sophistication of the AI is really key to assessing its actual power and its ability to consistently generate these claimed returns. Without that clarity, the term AI can sometimes function more as, well, a buzzword than a transparent description of technical capability.
That's a crucial distinction. It's the difference between a truly sophisticated, self-optimizing engine and maybe just a robust but predictable automated script. The sources focus on the outcome of the AI's work, the automation, but don't delve so much into the how. Okay, so now that we've sort of dissected the underlying engine, let's shift our focus to what often drives investment decisions, the potential returns. AI-FEEX presents two distinct staking options designed to cater to different investment horizons. First up, we have weekly staking. This option seems clearly designed for shorter-term engagement. It starts with a minimum investment of just 100 USDT. The system claims to offer an approximate daily return of 3%. Now, to give you a tangible example, if you were to stake, say, 1,000 USDT in this weekly option, the sources suggest you could see returns of around 13.5 USDT per day. Or if you think in terms of their platform coin, that's roughly 0.77 AFX daily. These are certainly high numbers for a daily yield. Then for those looking at maybe a longer-term strategy, there's yearly staking. This option offers a slightly higher approximate daily return, around 3.5%. Sticking with our 1,000 USDT example, the yearly staking could, according to sources, lead to about 15.75 USDT daily, or roughly 0.9 AFX. Now, these daily percentages, 3%, 3.5%, they are undeniably eye-catching. It indicates a focus on consistent granular returns. But for our listeners who follow the intricacies of finance, 3% to 3.5% daily compounded quickly becomes astronomical. From a financial sustainability perspective, how does a system credibly maintain such high, consistent returns, especially in the volatile crypto market? What are the mechanisms that make this feasible according to the sources? Or maybe what questions should investors be asking about this?
That's precisely the critical question an informed investor needs to grapple with. In traditional finance, returns of this magnitude compounded daily are almost unheard of without taking on significant, often undisclosed risk. The sources for AIFEEX attribute these returns to the powerful AI and its automated investment management. They suggest the AI is efficiently leveraging opportunities within the DeFi space. However, they don't explicitly detail the specific strategies like arbitrage or yield farming across multiple protocols, maybe market making that would generate such consistent, high daily percentages. A crucial element here is understanding if these returns are derived from real, external market activities that generate profit, or, and this is important, if they rely more heavily on the influx of new capital into the system. That distinction is vital for long-term sustainability.
That's a very important distinction to make, absolutely. What the sources do detail is how these AI-generated returns are shared. Okay, so 45% of those returns go directly to you, the investor, paid out every 24 hours. A significant 50% is allocated to the AI-EXX platform itself as profit sharing, acknowledging their operational and tech input. The remaining 5% covers system management fees, ensuring the smooth running of the automated processes. So this structure clearly outlines how the value supposedly generated by the AI is apportioned among the stakeholders.
This distribution model is fairly common in profit-sharing systems, but yeah, the sheer size of that 50% allocated to the platform is notable. It reflects either a substantial operational cost or perhaps a high profit margin for AIFEEX. What's worth considering here, particularly for an informed investor, is the dynamic relationship between the platform's profit share and the sustainability of your returns, the investor returns. A higher platform share could incentivize performance, sure, but it also means a larger chunk of generated profits is retained internally. That could potentially create pressure to maintain the high yields through aggressive strategies, or, as we discussed, perhaps through needing continuous new capital inflow.
Right. And here's a feature that the sources highlight extensively as a critical investor-friendly element. Your 45% share of the actual generated returns is paid out every 24 hours. That's daily liquidity on your profits. Perhaps even more compelling, especially in the often risky DeFi world, is the claim that your initial principal is guaranteed to be returned in full at the end of your chosen contract period, whether you opt for weekly or yearly staking. Now, a guaranteed principal return, that's a rarity in DeFi. How is this guarantee actually structured according to the sources? Is it backed by specific reserves, an insurance fund, or is it simply reliant on the platform's overall assets? And, what happens if the platform itself faces unforeseen solvency issues or a major market downturn?
That's a crucial question, because a principal guarantee in DeFi is indeed a powerful claim. The sources definitely highlight this as a core tenet of the AIFEEX system, designed to alleviate investor anxiety. However, the specific mechanisms underwriting this guarantee, they aren't detailed in the materials we reviewed. Typically, such guarantees would involve dedicated reserve pools, transparently audited, or maybe some form of insurance. Without that transparency, the guarantee fundamentally relies on the solvency and operational integrity of AIFEEX itself. If the platform were to face significant financial distress, or say a major security breach, the strength of that guarantee would inevitably come into question. It really asks investors to place a high degree of trust in the platform's internal financial health and its risk management capabilities.
Okay, so while the promise of daily payouts and a principal guarantee are clearly designed to instill confidence and attract investors, making DeFi feel more secure and predictable, it's essential to approach these claims with an understanding of the underlying operational and financial frameworks, or perhaps the lack of detail about them in the public documentation. So, putting it all together, what does this mean for you, the investor, looking at the bigger picture? This system appears strategically designed to emphasize simplicity and clear daily returns. It seems particularly appealing to those seeking passive income without the intense, hands-on trading often required in crypto. If you've been maybe curious about the crypto world, but perhaps deterred by its perceived complexities and volatility, this kind of automated, AI-driven approach, as described, really aims to remove those barriers. The reliance on AI here isn't just a marketing term, it serves as a major selling point. It aims to build confidence in the management and return generation, suggesting a layer of sophistication without requiring your direct intervention. And as we just discussed, that automatic principal return, as promised, helps to reduce anxieties for those less familiar with managing DeFi assets themselves. It's presented as a system built for convenience and, well, peace of mind.
And that raises an important question, doesn't it? Does an automated system like this truly simplify the often complex world of DeFi staking, making it more accessible to the general public compared to other forms of self-managed investment? What's fascinating here is that the sources repeatedly emphasize this ease of use. They position AIFEEX as a kind of bridge for a broader audience to engage with opportunities in decentralized finance without needing deep technical expertise. It reflects a strategic vision, certainly, to democratize access to these kinds of investment avenues. However, the trade-off for simplicity often involves a reduction in investor control and, crucially, transparency regarding the underlying strategies and risks. An informed investor understands that convenience doesn't necessarily equate to reduced risk, but rather a different type of risk, namely platform risk and the sort of black box nature of the AI's operations.
That's a crucial distinction. It's about where the responsibility for risk management ultimately lies. And just as an indicator of the platform's coin growth, the sources also mention the current market value of the AIFEX coin on a PancakeSwap, noting its price at 17.61 US dollars. This is an interesting data point because, as we discussed earlier, a portion of your returns is paid out in AIFEX. This snapshot of its value on a public exchange provides some context about the coin's current standing, but it also brings us right back to one of our core critical considerations.
Precisely. While the daily percentage figures of 3% or 3.5% are undoubtedly attractive, it's absolutely vital to remember that a significant portion of those returns is denominated in AIFEX coins. A key strategic point here, and one worth dissecting, is that the actual realized value of your total returns will ultimately depend on the market price of the AIFEX coin at the time you receive those payouts, or, whenever you choose to convert them back to a stable asset like USDT. The 17.61 USD mentioned earlier, that's just a snapshot, a price point at a specific moment. Future price fluctuations of AIFEX are a key factor you, as an investor, really need to monitor closely. So while the daily percentage figures are compelling, the ultimate worth of your investment is intrinsically tied to the market performance of AIXC's own proprietary token. That introduces an additional layer of market volatility beyond the initial stablecoin investment you made.
That's a vital point for anyone exploring this system. The potential for growth in AIFEX is there, yes, but so is the inherent volatility of a cryptocurrency. Okay, so to quickly recap our deep dive into AIFEEX's AI-DeFi staking, it's an investment system driven by AI automation, offering daily returns through two staking options weekly and yearly. And, crucially, it promises the return of your principal at the end of the contract. It's all packaged for convenience and aiming to generate passive income in the dynamic DeFi space. AIFEEX clearly presents itself as a potentially sophisticated, user-friendly entry point for AI-managed investments. For those of you considering AI-managed investments and wanting to explore that balance between automation, claimed returns, and platform-specific risk, AIFEEX certainly offers an intriguing case study. It's a compelling vision for simplifying DeFi, but it's critical for you as an investor to look beyond the initial numbers and understand the nuanced mechanics and dependencies involved. If you're interested in learning more or have specific questions about AIFE, the sources indicate that you can directly contact them. Their line ID is at AIFEEX. That's at AFIX. Just add that to your contacts and you can inquire for further details. We hope this deep dive helps you continue your exploration of this innovative yet complex space.